you so much for the kind introduction. Hi guys, very happy to be here with all of you. Gonna jump right into it. A lot of startups want to scale quickly, so it suggests we compare them to rockets, right? A rocket is a thing that can be quite powerful, that can really be a mode of transportation that takes you to places where other modes of transportation can take you. However, a lot of things can go wrong when you're trying to build a rocket too. And that's the reason why a lot of rockets or startups in that sense don't reach orbit. And one of the things that can be quite tricky is rocket fuel. So tonight I want to compare rocket fuel to venture capital. And tricky part about venture capital is if you, to stay with the analogy, if you have too much, that rocket might blow up. If you have too little, that rocket might not even take off in the first place. And there's a lot of steps in between that you need to know how to handle it. And this is what tonight is going to be about. I want to give you guys the basics, sort of like a crash course in rocket fuel. And why is that important, in my opinion? I want to start off with a quote by Charlie Munger, the genius partner of Warren Buffett. He says, "Show me the incentive and I'll show you the outcome." And I feel like, I mean, this is not just true in startup financing. I feel like that's true in all of life. So the better you understand the other side of the table, the more informed decisions you can make. So tonight, I really want to give you guys some infos on how are venture capitalists incentivized, what does their business model look like, how can they ideally support you. And if you soak all this in, then hopefully you can make better decisions and get the best out of the VC relationship. Just gonna move the pointer. There you go. Alrighty, very briefly, just so you have a bit of background information, I'm an investor at Sunfish Partners, which I co-founded in 2016, and my co-founders all have very strong entrepreneurial and or VC backgrounds. For instance, they co-founded Project A Ventures or Rocket Internet. We're currently based in Berlin, but we're also about to open an office here in Poland in the summer. And in terms of focus, we're focused on very data-driven teams. So this is all very early stage and very data-driven. And what we mean by data-driven, it means we look at a number of industries, so we're industry agnostic and not specific, but we're technology specific. So we ideally look for founders who are very technically driven, data scientists, engineering backgrounds, and who know how to handle data well by analyzing this, structuring this, or using that data to an advantage and solve a problem in an industry. So in terms of underlying technologies, we find ourselves a lot in the machine learning space, a lot in the blockchain space and IoT space, although they do overlap, because in the end they're all at the very heart about handling and analyzing data. In terms of investment, a typical first round investment for us would be around $1 million zloty, and then we make sure to reserve double that amount for later follow-on investments if the team develops well. Yeah, and about the market, we primarily do invest in Poland and a broader CE market, so I'm very happy to be here with you guys tonight. First of all, very broadly, what is it that VCs look for? And I have to make one disclaimer right here. I mean, tonight I'm going to be telling you guys a lot about sort of what VCs do, and a VC finance startup is one way how you can start a company, right? But you might as well bootstrap it, meaning not taking in your own money, or you might take in very little money from private sources, and then take VC money at a later stage, and there really is no right or wrong way to found a company. Tonight I'm really going to be focusing on the VC model to help you see if this is the right model for you guys with your companies, and if it's the right model at the right time, or if you guys might actually benefit from waiting a little with that. And primarily a VC looks at three criteria. The first one is the market. So we want to be sure that we're in an overall very attractive market, because even the best product and the best team, if the market doesn't have tremendous potential for growth, probably not good enough. And what's exciting here is also for us, it's very tricky to get the timing right, because a lot of markets, they might be hot in the future, but we don't have that much time, or they might have passed already. So typically, a venture capitalist has a fund for about 8 years, in the first 4 years are normally spent on investing. That's called the investment period. And the other 4 years are spent on exiting these companies, right? So it has to be a market where you can realize tremendous gains with companies within the next 8 years. So that's tricky part. And the second most important thing is the team. So we really want to make sure that we do have a team that's right for this market. So we want to understand, okay, why is this specific team great to do exactly what they're doing, right? And how are we sure this team is going to be motivated in 3 years, in 4 years, in 5 years, in 6 years to take whatever challenge is coming in this market? And how are they going to stick together? And why are they going to work together and conquer this opportunity? And the last one, although a lot of people would think it's the most important one, is the actual product or service. Because that's definitely going to change a lot of times, because there's so much uncertainty involved that no one can really say what's going to happen in 5 years and how exactly that product has to twist. So we want to be sure we're in an attractive market, and we want to be sure the team is really the right one to do that. Like this? Is that better? Okay, perfect. Sorry about that. One thing I want you guys to take away tonight is the word exponential growth. Because all of us human beings, we tend to think in linear terms, right? But the business model of venture capital is really about exponential returns. And I'm gonna walk you through that chart up here, right? So we have the company rank. So we have 20 companies in an example of a portfolio right here, and then we have the return of these companies. And in this case right here, you see that only 1 or 2 companies is where all the returns are coming from, and the rest doesn't really perform, right? I have a laser pointer, wow. Okay, so I do have okay, so you have the 1 or 2 companies right here who are performing super well, and the rest doesn't really perform that well. Whereas you would assume the perceived human motion would be, okay, some companies do good, some medium, some bad, right? But it's quite extreme in this case, and I'm going to give you some actual numbers. So you see, this is not theory. Those are numbers from the United States from 2004 to 2013. Why the United States? Because it's really hard to find good VC numbers for Europe right now. So if anyone's working on that, I'm happy to share notes with them. And here you see the extreme cases, and you see that the companies who multiplied by 20 or 50x, right? Here, if you add them up, that's 1.5% of the companies, right? Whereas the vast majority of companies right here made 0 to 1x, meaning they either lost value, as in a rocket that didn't make it, or stayed the same in terms of value. And this is important to understand for you as a startup. Because as a VC, of course, you want every company to succeed. But beforehand, you don't know which one is going to succeed. So you pick a couple companies, and you want to make sure to help them, to support them, but also to push them to make sure 1 or 2 of these companies in the end are gonna be these extreme outliers. I mean, ideally all of them, but that's not the reality what happens. And that's a very different thing from a VC standpoint, because we have a portfolio of companies. And it doesn't matter which one succeeds. As long as 1 or 2 of them succeed, then this business model works. Whereas for the individual company, of course, if you're not one of these companies, that's not so great, right? So you really want to think before taking on large amounts of money, are you at a phase where you're ready to be pushed and to be scaled and to be really like given a lot of rocket fuel? Or would that pressure be too much at this point in time? Or would it not make sense for your business from a strategic standpoint to scale this much at the current point of time? And I want you guys to never forget this. That's why I'm giving you an example. Because again, all of us human beings, we're so very bad at understanding the difference between linear and exponential growth. Right, so I have a piece of paper right here. The ripping part is not part of the experiment. Okay, so we have this piece of paper right here, and I want you guys to imagine how thick will this piece of paper get if I fold it 45 times, right? And normally what we do now, we think, okay, piece of paper, 45 times probably gets this thick or something, right? But again, this is linear growth. This is if I put 45 sheets of paper on top of each other. Then it's this big. But exponential growth is actually folding this, right? So fold it once, twice, 3 times, 4 times. So it gets thicker and thicker and thicker. right? And if we repeat this 45 times, what's going to happen is going to be quite astounding. Start very little. By time 25, we've reached the Empire State Building in terms of height, right? Because it always doubles. Then time number 26, we have twice the Empire State Building, right? So by time 45, we're all the way to the moon. In time 46, we'd be to the moon and back. So a couple more folds and we'd have the whole universe with a single piece of paper. So whenever you think exponential return, just think of this piece of paper experiment and never forget. This is also super relevant, not just for VC, but thinking about technological growth and outliers in terms of companies as well. It's also the reason why we have a number of companies like a Google, a Facebook, and an Amazon who combined are so much more valuable than thousands or millions of companies combined too. The business model of a VC. So what exactly does a VC and how does a VC make money, right? I mean, first of all, a VC starts out like a startup too. A VC has to fundraise. And I know that the word fun is in fundraising, but I mean, fundraising is not fun for anyone. It's not fun for a VC, it's not fun for a startup. So that's the same. Whereas a startup has investors, such as a VC has what's called limited partners. So also a form of investors who give them money, right? And normally they give them the money for about 8 years or so, and then they want their money returned. And ideally they want to have more money, of course, than before that. And that's one critical thing for you as a startup as well. You want to understand at what stage of the cycle a VC actually is. So if you have an investor that's investing in you, like I encourage you to ask them, okay, when did you raise your fund? How long do you have to go? Because it does make a difference if someone is, let's say, out of the 8 years, it's in year 3.5 and has about half a year left to spend their money for the teams, and then has another 4 years when they want to exit the teams, whereas if you're in year 1, right? And in real life, of course, that gets a bit more complicated because there might be several funds and they might have follow-on funds and so forth, but that's definitely one thing you want to like do a bit of prep when you talk to different investors. What's 220? That's sort of like the pricing, how VCs make money. 2 is normally a fee that's taken from the fund volume, right? Let's say if a fund has a volume of 10 million, then 2% per year is the money that the VCs can use to cover all their costs, from legal expenses to salaries to office to travel, right? But that's, at least for the little funds, is normally not why VCs do it. I mean, there's other jobs where you can make a lot more money in their position. What they're doing it for, what we're doing it for, is for the 20 right there. And the 20 means if the fund performs well after the 8 years, right, then the money, first it's subtracted, all the money that was invested. So that money is given back to investors. And then from the excess return, 80% is also given to the investors, and 20% is to be kept by the fund. And that's sort of where this game gets interesting, and that's, from a money standpoint, why VCs do it. Finally, the teams, most VC teams, even of big VCs, tend to be very small. While the startups keep growing and growing, the VC team, even if they add a lot of funds, might, because some expire, might add 1 or 2 or 3 people, but in general, the VC team remains fairly small. And generally, there's a couple hierarchies in a VC team. So you'll have a partner or multiple partners, then you will have like an investment director principal level, and you'll have an analyst level. And I mean, there's different names at different firms, but the general structure is basically the same. And generally, the bigger and more professional the fund, the more levels you will have. Getting the attention of a VC is not an easy task, and I'm using my laser pointer. I want to direct you guys to the number 344. I mean, I don't want to give too much credit to one single study, right? Because different studies probably have different numbers. But the general gist here to take away, which I think is valuable, is that VCs get a lot of pitches. And here, this number shows sort of that most VCs, on average, when they first have an interaction with the pitch deck, they have very little time to look at it. So you want to make sure that it really sells your story, and that's really clear and easy to understand. And you start with that first slide where you sort of like in a sentence try to say what you're doing, and then work your way up and make sure why the market is attractive, why the team is attractive, why the product works, have a fair view on the competition, and so forth. And really, I'd encourage you, like, no matter how complicated it is what you guys are doing, if a company as complicated as Google can explain in one sentence, in a nutshell, what their main mission is, what they're really doing, then every startup should be able to do that. Because you have a lot of startups who say, no, but what we're doing is so much more complicated than what everyone else is doing. We can't explain it, and that's fair, but then the chances of someone else understanding it are slim to none, and you're probably not going to make it until that first stage. A good tip I find is when you take someone who hasn't heard your pitch yet and tell them, okay, come here, John, I want to give you my pitch, and tell them, okay, I'm going to tell you now what we do, and then you pitch back to me, and you pretend to be me and tell me what we're doing. And this is a good way of seeing, okay, would I understand what this person is trying to sell me right here? Did I make myself clear enough, or do I have to practice? Here's an example from us. So this is like our deal flow in a year, right? So from the about 5 investments we want to make, we screen about 500 companies. So you can already see that it really does matter a lot how you as a company approach us and see us, because we sort of have to use, simply by the sheer amount, we're a small team, we have to use filters and so forth. And what could be a good filter? So right here, I have the stages, right? So we have incoming, what's called deal flow, just all the term sheets, that all the deals that come in. We have cold deal flow, if someone reaches out to us that we don't know. We have referred deal flow, that's if someone we know or trust, an entrepreneur we've worked with in the past, a co-investor, suggests someone to us. And we have generation, where we directly contact someone. And the latter two have a way higher chance of getting serious consideration and really making it down here. So for you to, I think it definitely pays off to go through your network and think, if you want an introduction to someone, to a VC, to not contact them directly, but really think, okay, is there someone in their network or my network that has a mutual connection, that could suggest me, that could do an introduction? So I mean, this can already go a long way. And I think it's also a good first test, right? Because we as VCs want to invest in entrepreneurs who are not shy, who are going to be very outgoing, going to be very sales driven, and going to make things happen in the next couple of years. So this is already a good test if you can get that first intro by talking to people. That's already good step one. One thing I read recently, which I thought was a fantastic quote, which applies in life as in venture capital. I'm going to read it to you. The results you'll get out of any given communication are directly proportional to the amount of energy you put into it. Very complicated way of saying one personalized email is a lot better than 10 generic emails. And this is really something to consider, because it does feel good if you just go through all the VCs you might have here in Krakow, wherever, or all the investors, and craft one standard email, hit click and send it to 10 people or 100 people and think someone is going to reply. But one well-crafted email that makes a lot of sense will get you way better results, right? To give you an example, also drawing on this quote right here from the article, which applies to us too, we have, on a daily basis, I get email from people who are looking for money, who are in different geographies than we invest in, who are working on different topics at different stages, so no fit whatsoever to what we're doing, right? And I can totally see this is an email that this person sent out to 1,000 people. And what do you think the likelihood are that we're going to work with this person? They're slim to none, right? So if someone puts in, because building a startup is super hard, and if someone puts in zero effort to write an email like that, the odds of actually getting funding from a VC are slim to none, I would say, right? And then normally I politely write, no, it doesn't fit our profile. And then sometimes an email comes back, no problem. Could you suggest 5 other people I could send this email to? Right? So I mean, this is fantastic. So this is I believe the worst signaling you can give an investor, right? Not only didn't you put in time to contact me, now you're also, although it's quite irrelevant, you're now also asking me to put in more time for you with another unpersonalized email. So really, you guys want to stand out here. This can really increase your odds of getting funding. The meaning of interested. This sucks for startups because if you see like VCs don't really have an incentive to say no a lot, right? Because it's always easier for a VC, even if they're not interested in a startup, to say, yeah, we're kind of interested. Let's stay in touch, right? Because they have nothing really to gain by giving the startup a clear no, but rather say, no, we're interested. So a lot of startups think, okay, this guy's really interested, and right now I have 10 parties who said, hey, they're interested. Why isn't anything happening, right? And here I think the key is to really look at the actions, right? Okay, is someone just saying we're interested, or is someone following up? Like, is someone wanting to meet me again? Is someone asking critical questions? Is someone doing background checks, talking to other people I'm working with, right? Is someone inviting me in? Is someone sending me a term sheet? I mean, term sheet is, we're gonna get to that in a second, like the basic form of a first agreement that you wanna work together. So you really wanna look at the action, and again, we try to be as upfront with entrepreneurs as we can, because we believe like the best answer obviously is a yes, but the second best answer in life is a quick no, rather than an I'm interested, and then nothing happens. One exception to this rule, of course, yes, there is sometimes parties where they say, hey, what you guys are doing is great, but you guys are way too early for what we do in our fund, right? And this might be true, and they do want to watch you, and maybe they want to invest in you 2 rounds later, 2 years later, right? But it's still important for you to understand it's good to keep the contact with them, but for now this is a no. So you want to focus your energy on parties that can actually help you in that moment. So there's a lot of different VC models to try to add different value, and I'm just gonna give you a couple explanations here, but there's a lot of hybrid forms in the middle, right? So the first one is what we internally call like the more passive VC approach, right? So the VC thinks of opportunities, of markets, and then finds investment targets by looking at them or by screening the deal flow, makes their investment, right? And then it's a very passive approach. So once that investment is made, every once in a while, like they'll do an intro to someone, but that's sort of it. And then eventually you'll have an exit event. So this is the very passive end. And then what we try to do for all our startups, we want to be at the very active end, which we think is good for the startups, but of course it has downsides too. It means we can only work with so many startups, because otherwise we simply won't have enough time and capacity to actively engage with all of them. And we have, so the only part that's really different here is the monitoring. Well, actually it's 2 parts different. We also do incubate ideas every once in a while, but I want to focus on the monitoring part. And this for us is not just monitoring, but it's actually, we try to spend a couple hours per week with every team that we're invested in to help them, and we help them build their organization specifically. Okay, how do you set up your organization? And this can be from a legal standpoint, but also like, who do you hire? How do you incentivize people? Questions like this. Then eventually we want to help them build their standalone business, right? Like to be able to sort of like fly their own rocket, and later on we want to help them support further growth. And this in particular is where we really help them go abroad, go to different countries, also like find very serious investors in later stage rounds, such as like big European or big American investors, because at a certain stage there's only so much funding available in Poland, but also even in Germany. Like once companies get really big, you really are playing at a global market, and it makes a lot of sense to sort of try to optimize your startup for this from an early day on. Because there's a lot of decisions that if you make them in the very beginning, and it's heartbreaking to see this, because this happens to a lot of startups, where you have in the very beginning, for example, like a very greedy angel who takes too much of the company, which obviously isn't the founder's fault, but indirectly it's the founder's fault too, because he made business with a person or she that wasn't all that professional. And that 3 years later, if the company is actually developing greatly, could be a big problem to get that big financing round, because that big VC from the United States is going to ask one question. Okay, how do I make sure the team is incentivized for the next 5 years if that angel from day one already has more shares than the whole founding team, which is going to work on this for the next years, go through thick and thin, right? So it definitely does help to try to be as professional, in particular if you want to build a very big and profitable organization in the long term. So I want to give you guys some guiding questions on how you can actually pick a VC, right? And the first thing I'd encourage you is to really be critical and ask the questions. Prepare well and ask the questions you want to ask, right? And I'm going to go through them with you. I mean, the first thing is actually it's sort of like the start of tonight, where you sort of like do a crash course like this in rocket fuel, but actually deep dive at home with your co-founders and really understand how does the business model work with the other party that you might want to work with. And I'm going to quote Peter Thiel here, which again is about exponential growth, this quote. It's, "The biggest secret in venture is that the best investment in a successful fund equals or outperforms the entire rest of the fund combined." Right? Peter Thiel is one of the first outside investor in Facebook, a successful founder from the United States. And again, this is really, the better you understand the other party and their incentives, the more informed decisions you can make. Then the second point here is don't be afraid to ask questions, right? Some founders think, okay, I'm afraid if I ask tough questions, the VC is not gonna like me. But it's quite the opposite, right? Like most good VCs, again, you saw the numbers. They pick 5 out of 500 teams. And the 5 teams they pick, right, they're the ones which they think, okay, these guys are the superstars that are going to be able, I want to bet my money, that they're going to be able to build a big company. They're not afraid to ask tough questions because there's going to be a lot of tough situations in their company where they have to hire, they have to fire, they have to compete in the next years. So someone who's well prepared and who asks tough and challenging questions is someone at least we at Sunfish prefer over someone who's shy and not afraid to ask the questions that matter, right? Because after all, this is going to be an intense relationship for the next 5-7 years. What are some questions which, if I were you, I would think about and then ask, right? The fund, I mean, I've slightly touched this. Where in your fund duration are you guys at? How much do you normally invest in companies? Then a thing, like I said earlier, like for us, we typically invest about 1 million zlotys, but then we reserve twice that amount to make another investment at a later round in that company, right? Ask questions like this: do you guys reserve money for later rounds? Because that's an important question too. It's not so important for an angel, right, who does this as a hobby. But as a fund, it's a really bad signaling if we as a fund put in money at first and in the next round the startup is trying to raise more money and we don't put in more money. Because then the other investors are going to be, wait, Sunfish has been in this team for 3 years. They're not investing again. They know way more than we do. Why are they not doing this, right? And again, there's exceptions to every rule. Some funds, they're only focused on the first round, and that makes sense and that's fine. But if you're going with a big fund, right, who normally makes bigger tickets, but gave you money at a pretty low valuation at an early stage, and then doesn't make an investment in the next stage, that's a pretty bad signaling for the market, and it's going to make it tremendously harder for you to raise money. So asking tough questions here really helps. And lastly, talk about expectations, sort of like, does their plan and your plan match, right? I mean, ideally, like the way you want to scale your company and you quickly want to build a big company, maybe an international company, is that sort of what they want to do too? Or do they want to push you more? Or do they want to push you less than what you need at that current stage? And last but not least, do your reference checks, right? I mean, we do them too. There's not a single team we've invested in where we didn't talk to former colleagues, former employees, where we had tech people look at their code, right? Where we had meetings with them, right? I mean, so definitely we try to talk to anyone we can to get as many data points as we can. So I'd highly encourage you guys to do that too, right? Because the best relationship is really one where both are confident that this is a great relationship. And really, so really, like when we call it due diligence, when we sort of like test everything we can test about a team, you guys, I highly encourage you to do that too. Yeah. So the ideal thing is, in my opinion, if both have other options but choose to work together, right? And that should be, and as it turns out, that's very often the case actually. So while there's very few companies that get financed with large amounts of venture capital, you do see normally that the ones who do are the ones who have a couple options, and there's a lot of them who have no options, and then a couple who have more than one offer, right? And you can also think, you're probably also likely to take in money from more than one party, right? So I think it makes sense to also think, okay, are these parties good at working together, right? So we definitely also want to know all the other investors when we co-invest with someone. Negotiating with a VC, right? So here I want to give you guys, and again, nothing I'm saying here is legal advice. You should definitely always take your time, try to understand this at home, and go through the critical stuff with a lawyer. But what's the basic assumption? Why do VCs like us make sort of like what's called term sheets with startups? The basic assumption is the VC is really trusting the startup, right? So we have a couple young founders here who have a big promise, and they get money for that, right? And the VC wants to make sure that the team actually works on that promise and doesn't take the money the next day, and give you an extreme example, and leaves the country and goes to the Bahamas, and so goes the money. So all the terms, and I'm going to go through some of them in a second, have the basic idea of making sure the team is incentivized to really do what they're promising, to stay with this product, this company for the next couple of years, and work very hard to try to make this a reality. And finding the right balance obviously is not easy, right? I mean, sometimes the VC wants to optimize, wants to get too strict terms in there. And a lot of VCs here have an easy game there, right? Because normally you as a founder, you're doing this for the first time. Even if you're a serial entrepreneur, you're doing this for the third time, whereas a VC has probably done this 10 times, 20 times, 100 times, right? So they tend to have more money to spend on lawyers as well in addition, right? So they have an advantage here. So what I would encourage you, I'm going to give you a couple terms now, which I think are very important that you understand what they mean. They're not bad terms, but you just want to understand what they mean because they have a big lever, right? And in particular, one of them, I'm going to give you a numerical example in a second, is liquidation preference. Vesting, what's the basic idea? The basic idea is pretty much that you as a founder, once we've invested, don't get your shares all at once, but over time. So if you stay with the company for another year, for example, you get 30% of your shares. Another year, you get 60, and after the third year, you get the full package. Again, what's the reasoning here? You as an investor don't want the founder to take the money and then run away with it, right? Then you have the anti-dilution protection. What does this mean? This is basically if you have a founder raise money and then in the next round raise at a lower valuation. So theoretically your company has gotten less of a valuation. What's going to happen to your shares? And the VC normally wants to protect it in this case. And this is one big takeaway, by the way. Raising the most amount of money, while it might be fantastic in the moment, is oftentimes not what maximizes your odds of success. It's also not what increases the pie a couple years in. So whenever we make an investment, we sit together with the founders and say, okay, what's the goal? Where do we want to be in 7 years? And then we sort of go back all the stages, right? And see, okay, you probably need money 3 more times or something like this. And we want to have very professional, very big US investors in here in 4 years. And we try to sort of like go all this way back and then try to find ideal amounts, right? Because taking on to too much money, because you're promising too much, is not a great thing. Because then what's going to happen in the next round, if someone asks you, okay, so what happened to your promises you made a year ago? You're like, yeah, we're not there yet. And then the whole like spiral can really turn against you, right? If you're not able to raise that next round or not at the valuation that you want to, that's going to give you a really hard time. And finally, the drag along and tag along is just to protect minority or majority shareholders, in particular when it comes to sales. The key takeaway here is money is one thing, the terms do matter a lot, right? And this is very unlike what you see in the news. When you read on TechCrunch or on blogs, you see startup X raised amount Z, right? And this number might seem impressive or not, but a single number without knowing the terms that stand behind this number says really nothing, right? And I'm going to give you one example of one term that's a good example for this, because that's not what you're going to read on TechCrunch. It's called the liquidation preference. Liquidation preference, let me do a white screen first somewhere. Oh yeah, no. So liquidation preference basically means that if the company is sold, the investor first gets the money back, right? And what's the idea here? If I give you 1 million now for 10% of your company, right? Then all of a sudden your company has 1 million and you have 90% of the shares and I have 10% of the shares. So tomorrow you could say, hey, Marcus, come here. We have a vote what we're going to do with the 1 million. I think I should buy a new house now. And I was like, oh no, I don't want that. You're like, yeah, I have 90% house bought, right? So that's the basic idea of a liquidation preference. Liquidation preference, it just means if I give you 1 million now and you decide to sell your company or buy a house, whatever, tomorrow, you can only do that after you've given me that 1 million back. And then with the excess return, we can do stuff. So it makes a lot of sense from a logical standpoint, and no founder should be against this, really. What you then see, however, and this is also not that uncommon, that VCs say, okay, but I don't want a single liquidation preference. That was our example. I want a double or triple, right? Meaning when the company gets sold, what first happens, I want my money back twice, and then the rest that's left over is going to be split. I'm just going to give you an example, right? The news on TechCrunch is sold company for 30 million, right? And in one case, if we have a one-time liquidation preference, right? That's very different than when we have a two-time liquidation preference. And I'm going to give you an example here. So the 5 million was invested earlier at a 15 million valuation. So in total, that's 5 divided by 5 plus 15. So 5 over 20. So that's 25%, right? So the VC owns 25% of that company. And then the company gets sold for 30 million. But first, before any money goes to the founder from the 30 million, the investor gets twice the liquidation preference. So he gets 5 million and another 5 million. So from that 30 million that you just read on Crunchbase or in TechCrunch, right, 10 million is already gone for the liquidation preference. And from the remaining 20 million, right, now we're doing the game, okay, the investor owns 25% of whatever is left, and that's 25, and you get the additional 5 right there. So with a 2 times liquidation preference, and different examples will look differently, obviously, but in this case, 25% could really mean a 50% of the company. And this is just one example, right? And this shouldn't be too scary or too daunting, because again, like the basic ideas behind these terms, they make sense, they're good, but you want to make sure that you're not negotiating with a party who's trying to bend it all in their favor and not in your favor. And actually, one initiative we've recently started, we've partnered up with Gessel, a law firm, and we want to create some standard documents for the Polish market. This is all going to be free and open source, and we're just going to write up the basic terms in English and in Polish, and going to outsource this to the whole community, and hopefully this will help founders in the future and VCs to A, save legal costs, but B, to really find fair and transparent terms that everyone can understand. And if there's other, we're currently reaching out, if there's other investors or other interested parties who want to help set up this initiative, then you're more than happy to talk to me in that regard. Yeah, finally, one thing, it's very important to understand leverage. And this looks like a very trivial slide, but it couldn't couldn't be more true, right? Fundraising takes long, right? I mean, fundraising easily takes 3 months, 4 months, 6 months, the whole process, right? So you do want to make sure that you start this process early, because the less money you have in your bank account, the odds are not, the fewer negotiating power you really have, and it always makes sense to negotiate out of a power of strength, where you can actually, because it does take time to find a good VC, right? As you've learned, or make the decision, is venture capital the right form of financing for me right now? And the more time you have to make these decisions and you're not under pressure, the better. Obviously. Alrighty, so I'm gonna end it with the rocket right here. I hope that this crash course in rocket fuel, as known as venture capital, was helpful, and I truly do believe if you do understand the incentives, the business model, and also what kind of value a venture capitalist can add, then you're in a way better position to make smart decisions, and you can get way more out of a relationship with a venture capitalist, which obviously would be very good for your company. Thank you so much.
All right, I should be using this one. So because we have a lot of content, I think that we should see what our energy level is like at the end of the event and maybe do an extended conversation and questions. But if someone has a pressing question right now, they want to ask Marcus, let's do one question from the audience right now. Does anyone have a question?
Right there.
Out of the 5 companies you invest in, how many are pre-revenue? Pardon me? How many of the 5 companies you invest in are pre-revenue versus?
Most of the companies we invest in don't have a lot of revenue, no. I mean, we do look for first traction, but traction in our case could also mean, okay, show us some customers that you're currently playing this out with, and sometimes we already have paying customers, but I wouldn't really consider this revenue, because those are like the very first like lighthouse customers where the terms can be very different from what the actual terms would be if you have a lot of customers. So we're very open to doing stuff before revenue. Cool. Alrighty, I'm going to be here all night. Thanks.
Round of applause for Marcus again. Thank you.